Modern governments do not repay their debts the way households do. They do not accumulate surpluses and gradually pay down principal. Instead, they roll. When a 10-year bond matures, they issue a new 10-year bond. When Treasury bills come due, they sell new bills. This process, executed continuously across global bond markets, is what keeps sovereign debt structures stable. It is not repayment. It is refinancing. And when that refinancing stops, the consequences unfold rapidly. A government loses the ability to roll its debt when investors refuse to buy new bonds at viable rates or refuse to buy them at all. This is not a theoretical risk. It has happened in developed economies, in emerging markets, and across different monetary regimes. The mechanism is the same. The state owes money. The money comes due. No one will lend more. At that point, the crisis is no longer financial. It becomes fiscal, political, and systemic. Understanding how this happens requires looking past headline debt ratios and focusing instead on the mechanics of refinancing itself. Debt sustainability is not determined solely by the stock of debt. It is determined by the flow of financing required to maintain it. The concept at the center of this process is gross financing need. Gross financing need is the total amount of money a government must raise in a given period. It consists of three components: the fiscal deficit, which is the gap between spending and revenue, the interest due on existing debt, and the principal on bonds that are maturing. A government with a small deficit can still face enormous financing need if a large share of its debt matures within a short window. This is the maturity wall problem. It measures not whether debt is sustainable in theory, but whether it is fundable in practice. Countries with large gross financing needs relative to GDP face elevated rollover risk. Even if their debt to GDP ratio is moderate, the sheer volume of bonds they must place in the market each year creates vulnerability. If investor sentiment shifts, if yields rise, if global liquidity tightens, the refinancing machine stalls. And once it stalls, options narrow quickly. The structure of debt matters as much as the quantity. Governments issue debt across a range of maturities. Some borrow for 3 months, some for 30 years. Long-term debt offers stability. It locks in financing for decades and reduces the frequency of refinancing. Short-term debt is cheaper in normal times, but it must be rolled frequently. When investors lose confidence, they stop buying long-term bonds first. Governments respond by shortening maturities, issuing more treasury bills, accepting higher rollover frequency in exchange for continued access. This is a warning sign. It reflects deteriorating creditor trust. And it amplifies the very risk it attempts to manage. The more debt that comes due in the near term, the more financing is required, the more sensitive the fiscal position becomes to any shock. The currency in which debt is issued introduces another dimension of risk. Domestic currency debt can, in principle, be financed by the central bank. The government borrows in a currency it controls. Inflation may result, but default is not mechanically necessary. Foreign currency debt is different. It requires access to external markets or foreign exchange reserves. If reserves are depleted and external creditors withdraw, the government cannot print its way out. It either negotiates support, restructures, or defaults. This is why emerging market crises often escalate suddenly. Foreign currency debt creates hard constraints. When refinancing fails, there is no domestic monetary backstop. Reserve adequacy is therefore a critical variable. Central banks hold foreign exchange reserves to manage liquidity, stabilize the currency, and service external obligations. When reserves fall relative to short-term external debt, vulnerability rises sharply. Investors begin to price in the possibility that the government will be unable to meet upcoming obligations. This expectation becomes self-reinforcing. As confidence erodes, capital leaves, reserves fall further, and the threshold for crisis moves closer. The early signals of rollover stress appear in bond markets before they appear in policy announcements. Yields begin to rise. Spreads widen relative to benchmark rates. Auction results weaken. Coverage ratios, which measure the ratio of bids received to the amount offered, decline. Maturities shorten. These are not abstract indicators. They represent real changes in investor behavior. They show that creditors are demanding higher compensation for risk, that they are less willing to commit capital for long periods, and that they are preparing for the possibility of non-payment. As yields rise, the cost of servicing debt increases. This creates a feedback loop. Higher interest costs expand the deficit, which increases gross financing need, which requires more borrowing, which drives yields higher still. If the government cannot credibly commit to fiscal adjustment, the loop accelerates. Political constraints often prevent the tax increases or spending cuts required to stabilize the trajectory. Governments delay. Markets penalize delay. The gap between what must be financed and what can be financed widens. Eventually, the government faces an auction that does not clear at an acceptable rate or does not clear at all. Bond auctions are the institutional mechanism through which refinancing occurs. The Treasury announces an offering. Primary dealers submit bids. If demand is strong, yields are low and stable. If demand is weak, yields spike, or the auction fails outright. A failed auction is not common, but it is not unprecedented. It signals that the market is no longer willing to absorb the government's financing needs on any terms the government can afford. When this happens, governments respond in predictable ways. They shorten maturities further, issuing bills instead of bonds, hoping that short-term investors will remain engaged even as long-term investors exit. They turn to captive buyers, pressuring domestic banks, pension funds, and insurance companies to absorb bonds. They delay payments on non-debt obligations, hoping to preserve liquidity for creditors. They impose capital controls to prevent outflows and stabilize the currency. These are not solutions. They are emergency measures that buy time, often at the cost of deepening the underlying problem. The domestic banking system is typically the first line of forced absorption. Banks hold government bonds as assets. They use them as collateral in funding markets. They are required by regulation to hold them for liquidity purposes. When a government loses market access, it turns to its banks. The banks, facing implicit or explicit pressure, continue to buy bonds. But this creates a sovereign bank loop. As the government's creditworthiness deteriorates, the value of the bonds held by banks declines. Bank balance sheets weaken. Credit to the private sector contracts. Economic activity slows, reducing tax revenue, expanding the deficit, and increasing the government's financing need. The loop reinforces itself. The sovereign and the banking system become jointly vulnerable. This dynamic accelerates the crisis timeline. What begins as a liquidity problem becomes a solvency problem. Markets begin to price in the possibility of restructuring or default. Yields rise beyond the level at which debt can be stabilized. The government's options narrow to 4 broad categories, each with distinct consequences. The first option is official financing. The government seeks support from multilateral institutions, primarily the International Monetary Fund, or from bilateral creditors. This provides liquidity in exchange for policy conditionality. The government commits to fiscal consolidation, structural reforms, and macroeconomic stabilization. If the program is credible, market access can be restored over time. If it is not, the program becomes a bridge to restructuring. Greece in the early 2010s pursued this route. It received substantial official support. It implemented significant fiscal adjustment. It eventually restructured its debt. The official financing provided time, but did not eliminate the underlying need for debt reduction. The second option is financial repression. The government uses regulatory and policy tools to force domestic investors to hold its debt. Banks are required to maintain minimum holdings of government bonds. Pension funds are directed to invest in domestic securities. Interest rate ceilings are imposed to reduce borrowing costs. Capital controls prevent residents from moving savings abroad. This allows the government to continue financing itself at below-market rates. The cost is borne by savers, who receive negative real returns, and by the financial system, which becomes increasingly distorted. Financial repression was common in the mid-20th century. It remains a tool in environments where external market access is closed and political constraints prevent explicit default. The third option is monetization. The central bank begins purchasing government bonds, either directly or through secondary markets. This provides the government with financing, but it erodes the nominal value of debt through inflation. If inflation expectations remain anchored and the monetization is temporary, the strategy can succeed. If inflation accelerates and expectations de-anchor, the result is high and persistent inflation, or, in extreme cases, hyperinflation. The boundary between controlled monetization and inflationary spiral depends on central bank credibility, fiscal discipline, and the scale of financing required. Russia in 1998 attempted to manage rollover stress through monetary accommodation. The result was sharp depreciation, inflation, and eventual default. The fourth option is restructuring or default. The government acknowledges that it cannot meet its obligations on the original terms. It proposes a reduction in principal, a reduction in interest rates, or an extension of maturities. If the debt is held primarily by external creditors, the restructuring is negotiated through collective action clauses or ad hoc committees. If the debt is held domestically, the restructuring may be imposed unilaterally. Default is the most explicit acknowledgement of insolvency, but it is also the mechanism that allows the debt burden to be reset. It comes with significant costs. Market access is lost, often for years. The banking system typically suffers capital losses, economic activity contracts. But for countries where debt is unsustainable and official support is insufficient, restructuring is the only path to fiscal stabilization. Each of these outcomes reflects a different political and economic judgment. None is costless. The choice among them depends on the composition of the creditor base, the structure of the economy, the strength of institutions, and the willingness of the population to accept adjustment. But the choice is constrained by the mechanics of refinancing. Once market access is lost, the government no longer controls the timeline. The crisis moves from technical finance to political economy, and the range of feasible options collapses. The historical record shows that rollover crises do not emerge without warning. They build gradually through observable changes in financing conditions. Redemption schedules become more front-loaded. Gross financing needs rise as a share of GDP. Auction outcomes weaken. Foreign exchange reserves decline relative to external debt. Domestic banks become overexposed to sovereign risk. Political discourse becomes polarized around fiscal policy. These indicators do not predict the exact timing of market closure, but they identify regimes where closure is possible. What distinguishes a manageable refinancing environment from a crisis-prone one is the margin of safety. Governments with long average maturity, diversified creditor bases, strong reserve positions, and fiscal flexibility can absorb shocks. Governments with short maturities, concentrated exposures, depleted reserves, and political gridlock cannot. When the margin is thin, even small changes in market sentiment can trigger withdrawal, and once withdrawal begins, it accelerates. The transition from stability to crisis is nonlinear. For extended periods, markets may tolerate rising debt and weakening fundamentals. Yields drift higher, but auctions clear. Then, at some threshold, the dynamics shift. Investors conclude that the debt is unsustainable. They exit. Yields spike. Refinancing becomes impossible. The government is forced to choose among the four endgames. The shift can occur over weeks, It is visible in the data, but it is difficult to reverse. This is the mechanism through which governments lose the ability to roll their debt. It is not a failure of will. It is not a failure of communication. It is a failure of financing. When creditors decide they will not lend more, the government must either adjust its obligations or restructure them. There is no alternative. The fiscal arithmetic becomes binding, and the political consequences follow. Rollover failure is mechanical. It operates through bond markets, central bank reserves, and banking system balance sheets. It is visible in advance through financing indicators and market behavior. But once it begins, it narrows the range of policy options quickly. Understanding the mechanics does not prevent crises, but it clarifies what is at stake when governments depend on continuous refinancing to sustain their fiscal operations. And it shows why the structure of debt, not just its size, determines whether that refinancing can continue. If you found this analysis useful, consider subscribing to the Economic Record. We examine the mechanisms behind economic events. No speculation, no hype, just the institutional record. New episodes cover monetary history, fiscal systems, and the architecture of modern finance. Thank you for watching.